So let me ask you about the current situation, because one of the really extraordinary things about Bill is that he can take a long-term view, what they call their secular view, but then as a trader and an investor, he is very flexible, and so he can deal with the opportunities that arise, even if they contradict kind of the long-term view. So what's going on right now, Bill, and there are some dissenters out there, as you know, to your new normal. One of them is Jim Grant, who wrote a really interesting article in the Wall Street Journal, I guess not this past weekend, but the weekend before, and basically saying that the deeper the slump, the zippier the recovery in his essay. And so we are seeing, and then Rob Arnott, who actually runs some portfolios for you, the total asset kind of structure, was talking about we've had the mother of all stock market rallies. The last 6 months have been since 1975 have been the biggest rebound in the stock market. So you have in the near term, you've got some pretty phenomenal growth, at least from an investment point of view, mm-hmm. and you've got the Jim Grants of the world saying, look, the worse the recession, the better the recovery. So what do you say to those?
Well, I thought Grant's piece was interesting,
mm-hmm.
and Jim is an excellent historian. I mean,
yeah.
His books, formed the foundation and premise for PIMCO. Looking for something to happen in the early 21st century, so not to downgrade Jim Grant, but I think he misses the point, and it's the same point that actually Barton Biggs made 6 to 12 months ago when he said he was a child of the bull market, which in Barton's case a brilliant phrase, and in Jim's case a brilliant writer, but the point of each was that, as you mentioned, the bottom of the V, or each side of the V, basically should be not equidistant, but well, the side should be equidistant. The downturn should be replicated by an upturn
right.
on the upside. The new normal, is sort of a subjective type of outline, and so let me get a little more objective in terms of why we think growth will be slow and why the V probably won't occur, and that's because there are a number of models that we're all familiar with that I think in terms of a probability assessment probably are broken and won't come back, probably won't ever come back. Example, the automobile industry. To think that of course General Motors is back in business, but to think that we could produce 18 million cars in the United States anytime soon in terms of this V, and that was right. Where the top of the V was for autos, we're down to 10 million, and so that would be a giant leap. Same thing in real estate. To think that we could produce 2 million houses again anytime soon. The housing market was driven by second home and speculation that probably won't come back for a long time. And to the extent that housing doesn't come back, then what does that say about realtors? Realtors were 24 months ago were 1% of the employed in the United States, and now that's been cut in half. And of course, it's dependent upon housing prices having gone down as opposed to up. The model in terms of consumption versus savings. The United States was a dissaver only 18 months ago. We had a negative savings rate. Typically, and before the old normal matured, the savings rate in the United States and elsewhere around the world was an 8 to 10% type of number. And so that means that we have to save money now as opposed to spend it. And so these models, housing, autos, employment, employment used to be standardized in terms of the old normal at 4 to 5%. Now, of course, and on Friday, we'll probably reach 10 or close to 10. And so I guess what I'm saying, and let's include, let's not just pick on realtors, let's pick on Wall Street. Investment bankers, investment managers, and associated industries, lawyers, and so on that that toiled through the night to make prospectuses and those types of things. Are they coming back to the same extent that we knew them 2 to 3 to 4 years ago? Probably not. And so the very fact that these models are breaking down and in many cases have broken, suggests that we can't get back to the top of the V anytime soon. And one last point, probably the largest model that's in question at the moment is the ability of the United States to continue to sell paper to the Chinese and to others at, in the case of a 10-year treasury at 3 1/4, but in the case of a treasury bill at 0.15%. How long will others who have absorbed trillions and trillions of dollars of paper be willing to put up with these low interest rates going forward? So that was the old model. The new model is subject to question.
All right. So let me. Do you want some water? Are you all right? So let me ask you about the debt situation. So we've got a federal deficit of $2 trillion this year. Is that right?
Getting there.
And of course, PIMCO is a major player in the treasury markets as well. So what's the impact going to be of this debt issuance that we've got? And I think also you know this, that the maturity on treasuries is now something like 4 years. So we've got these rollovers of treasuries that we've got the system has to absorb. Plus we've got this $2 trillion debt that we've got to refinance. So what's the impact going to be on interest rates and the dollar?
Well, at the moment, it hasn't had any impact, which is surprising.
Yes, right.
Break down who buys these things, and I can guarantee that many of you in the audience have some treasury bills, and if you don't,
raise your hand.
Your money market fund does it, and so you've participated in terms of funding the deficit to that extent. I mentioned the Chinese. I mentioned others. They have lots of money to put to work, and that's been a natural reciprocal. The saving grace, really, I think, at the margin, has been the fact that Uncle Sam himself, I guess that's still okay. He's still an uncle, right? So he's a guy.
That will be a real change. When Uncle Sam is a sex change, it's a whole other discussion.
But Uncle Sam's been buying a lot of his own paper. This is fantastic. I wish I could invite you all to the trading room at PIMCO to see exactly what takes place. But the Treasury almost every week, offers and sells 20, 30, actually $100 billion worth of paper every other week, whether it's 3s, 5s, 10s, 30s, whatever. Surreptitiously, and actually not surreptitiously, but not known to the general public, is that the Federal Reserve, almost within minutes of Uncle Sam, the Treasury, having sold the paper, the Federal Reserve starts to buy it. In other words, one hand of the government sells, the other hand of the government buys, and those are the well-announced programs of $1.25 trillion in terms of mortgages, and $250 billion in terms of treasuries, and $250 in terms of agencies. In other words, they're sort of helping to keep interest rates low by writing checks for themselves. If you could write a check for yourself without having to worry about the balance, then it would be a wonderful household, and you'd have a great future to look forward to. So that's what they do. So the problem is, though, that the politics are interfering. Congress is getting a little upset that they're writing too many checks, and the Fed itself, Bernanke himself, is worried that they might at some point overdo it. And so this huge $1 trillion, $2 trillion, $3 trillion check writing program that most of the public doesn't know about will be winding down, and there's the risk.
And so when is that going to wind down, and when, therefore, should we be unloading our treasuries, and have you already?
Well, actually, we're buying them, darn it. It would have been a good story.
Are you buying them?
Yes.
Okay.
It's going to wind down at the end of the year. They've announced that game over for treasuries and agencies at the end of the year, and then they've announced the mortgage program game over in March of 2010. That doesn't mean that they won't bring them back or can't continue, but for the moment that's what they've said. The real question becomes as to whether treasuries are attractive without that support is really the health of the economy in 2010. The hope is that all of this stimulation, has produced green shoots. That's the famous Bernanke phrase. And in fact, we have a green shoot in terms of the third quarter and the fourth quarter economy ahead of us, mainly, in our opinion, due to inventory accumulation, but nonetheless, we're moving in the right direction. If 2010 is a good year, then no, you don't want to own treasuries. If 2010 is a year in which it becomes more clear that the new normal, as opposed to the grant view of a V, becomes apparent, then treasuries are still a bargain, because ultimately bonds and even all investments are in part dependent upon inflation. If there is no inflation, then bonds are still attractive. If there is inflation, then they're not.
So here we have Bill Gross here, so I've got to ask him, so Bill, do you think inflation is going to be a problem, and why are you buying treasuries? And I'm going to preface that with the fact that one of Bill's big investment themes last year was to shake hands with the government. So basically, if the Fed's buying treasuries, I guess we as investors should be buying treasuries too. And then when I talked to you in June, it went from shaking hands with the government and being in partnership. 63% of the total return fund was in mortgage-backed securities. It became another, instead of shaking hands, and Bill can only do this, I can't do this. There was another handshake that Bill said that PIMCO had adopted. Howie Mandel?
the fist bump, yes.
So you went from this to this?
Sort of. And Howie, for those of you that don't know, Sue loves Howie Mandel, and he has a number of programs, but whenever he greets his guests, it's always because he's
a germaphobe?
A germaphobe, and he refuses to shake. And so Howie's sort of the symbol of someone that's becoming leery of the government as opposed to giving them a firm handshake. So
where are you buying treasuries? So are you here, but you're still buying treasuries? So why?
Well, one of the problems is that the markets have all done so exceedingly well. And obviously those of you that thought you had 201ks 6 months ago in March, now at least have 301ks. And those of you that invested in high yield bonds back then have probably doubled your money. And so almost all risk assets, not all of them, but almost all risk assets have narrowed in spread and yield to the point where they're becoming treasury-like. That doesn't mean that a high-yield bond is yielding 3%, but it used to yield 15 to 20, and now it yields 7 to 8. And the same thing with mortgages. Those mortgages that we loaded up on to shake hands with the government are now close to the same yield as treasuries. And so it becomes a question of why not treasuries, because the yield is beginning to mimic everything else. In other words, the markets have been de-risked, and it becomes a question as to how much risk is remaining, and that's the 2010 question mark for the economy.